Welcome back to the channel. My name is Brad, and today we are going to cover what is in my portfolio, what have I bought, what have I changed, I think I'm going to be putting more money into, and everything else. If that's what you're looking for, stick around. So I've been retired now for 7 months. I've changed around my portfolio here and there to things that I am comfortable with in retirement. And it's basically due to I understand what's going on with a little more transparency than sometimes reading income statements and figuring out what companies or closed-end funds or anything else is doing. So why do I income invest? And it's called sequence of return risk. Basically, this is a chart of if I had $100,000 and I took 8%, depending on when you started and what the market did. And if you notice, these are the same percentages, just in different order. You could end up with $169,000 after 15 years, or you could end up with $45,000 after 15 years. So it's up to you. This is a sequence of return risk. This is why I income invest, so I can get away from sequence of return risk. This is why you'll find financial advisors tell you you can only withdraw 4%. You're lucky if you can withdraw 5%. And they're using historical data, and I fully agree with their historical data. I have personally tested this with historical data, and it is 100% true what they're saying if you take it all the way back through time and history. But there has been some changes over the times, and we will cover that next week when I do a deeper dive into sequence of returns. What does this look like on a chart? Well, you can see, good start, we're up. Bad start, we're down. You do not want to be in the bad start. You want to be in the good start. Now, historically, 35% of the time, we have a negative year. Unfortunately, this chart also covers the Great Depression. What most people don't know is the Great Depression, a lot of years in the negative, years in the positive, boom, bust. So my comment to all of this is when I do a deeper dive into sequence returns, when did we go off the gold standard? And that might be something that you take into consideration. Before the gold standard, the economy worked one way. After the gold standard, the economy worked a different way. You have to take changes in market conditions into consideration. That's all I'm saying. Before the gold standard, after the gold standard, but that is a video for another time. I use 5 pillars: cover calls, business development companies, preferred stocks, alternative assets. That includes Bitcoin, REITs, and bonds. Collateralized loan obligations. That is a different animal. I am going to leave some links down below so you can go review some collateralized loan obligation funds and my thoughts of how they work, and some risk and rewards, because there's always risk and rewards when you invest. The other thing I take a personal look at when I do this is what is the percentage of downturn I can handle with the percentage that I'm getting. I try to stay with funds that have a slightly higher downturn percentage because I understand that. I also stay with funds that I can personally look at their calls and their call writing or where they're getting the revenue from to make sure that they're not just giving me my money back. That is just me. That is what I'm comfortable with. That's why you don't see me investing in certain funds that use like an ELN. I can't see where that money's coming from. I'm sure they're doing a great job. I'm not taking a shot at them because they're using an ELN. But the transparency is not there for me to personally feel comfortable with it. I look at these calls, I can calculate these calls, I can see exactly where my income is from, and that's something to do with just my personal feelings. So without any further ado, I am going to jump into this. I'm going to give a couple caveats right up on the beginning because I always get questioned. Number one, these are all in IRA and Roth IRA. Yes, I worked for a big company. Yes, I saved a lot of money in tax deferred accounts. I do not use leverage. Nothing wrong with using leverage. I don't need to use leverage, so I don't use leverage. That is my personal opinion. And there are tons of channels that cover leverage usage. I'm just not one of them because I don't need to use leverage. Now, let's talk about cover calls. I still own my SPY. It pays me 12 to 13%, and the expense ratio is about 0.68. QQQI, it pays me about 13 to 14%. Its expense ratio is 0.68. IWMI, which is the Russell 2000 from NEOS, pays me 13 to 14% with an expense ratio of 0.68. GIAX. So the very first funds were longer dated covered calls. GIAX sells call spreads. I like longer dated calls, call spreads, and I have a 0 DTE. That is the three different ways that I'd like to play the market. Which one is better in which market conditions? Who knows? If it's sideways a little bit, one fund does better. If it's up market, another fund does better. If it's a down market, another fund does better. I'm diversifying across all of them, so I don't have to worry about where the market goes tomorrow, next week, next month, next year. GIAX has a distribution rate of 24%. It has an expense ratio of 0.97. Remember, they're selling weekly, and that is a different animal because somebody has to manage those calls weekly. Now, I also have SPY-T. SPY-T pays 20%. Their expense ratio is 0.87. They sell call spreads daily, so it's a little more involved. And by the way, it's the same people writing the call spreads for GIAX as writing them for SPY-T. My next fund that I have is FEPI. It pays approximately 25%. It has an expense ratio of 0.65. This fund has done very well. I am going to go ahead and lower those funds in FEPI over time. And I'm really just taking some of those funds and building out other things. And I'm going to take some of those funds and put it into the next one. The next one's called AIPI. It's paid 34% with an expense ratio of 0.65. It is really a sister fund of FEPI, ran by the same people. They make very similar calls. One is more evenly weighted, one is more heavily weighted one direction than the other. One's on AI, one has the Magnificent Seven. So I'm just splitting them up to what I like. And I'm just going to use a little bit of the FEPI money to build out other things, such as AIPI and some of the alternatives. And I also own T-SPY. T-SPY is my 0 DTE fund. Now you can hold XDTE, but that's a synthetic. One thing that I will point out, and I will continue to point out, none of the funds, 0 of the funds, absolutely none, I can't stress this enough, hold synthetics. Nothing. They all hold the underlying. I'm going to link an article below so you can go find out if you want to get into synthetics or buy something that actually holds the underlying. That is just my personal opinion, and it's up to you. I'm not your financial advisor, not your mom and dad. You can make your own decision, but I do not invest in synthetics for the long-term hold. The last one I have, and this is a very small percentage, is GPTY. This is on AI. It has an expense ratio of 0.99, and it's a very, very small holding. This holding will never get, hopefully never gets above 0.5%. Yes, 0.5%. Not even a 1% holding. It is right now in the decimal points. So if it gets up to 0.5%, I'll start selling some shares off. It will never get above 0.5%, but it pays weekly. Everything else that I just covered pays monthly. The next one is business development companies. I own PBDC. It pays about 9%. It has an expense ratio of 13.94. Oh my goodness, I can see the comments now. Link down below to an article to explain the expense ratio. Unlike other ETFs and corporations, they have to put into their calculation the expense ratios of every business development company that they own, but they do have some waivers into that expense ratio. Their management fee, and that is what I'm worried about, is 0.8. Just throwing it out. Link to an article down below so you can not bother me about percentages. And by the way, and this is another one that I got hit up with, it's not a negative 4%, because some people take, oh, it's only paying 9, but the expense ratio is 13, so it's a negative 4%. I literally have seen that math. And obviously that person had a problem in math class back in high school. That is not the math that occurs. So trust me, it is 9%. It's an acquisition cost is that expense ratio, and the management fee is 0.8. I also own BIZD. It's paying 10.54, and its expense ratio is 13.33. Now, the difference between PBDC and PIZD is one is professionally managed, and they are looking at the funds and picking which business development company to get into. BIZD is really an index of all the funds. I personally don't hold individual business development companies. That is something that I chose to do a couple months into retirement. I said, I am not going to sit here and worry about every single day what's going on with this business development company, what's going on with that business development company. Oh my gosh, what's this one going on? Don't have time. I'm going to buy something professionally managed or the index. Both make my 8%. The next one actually is really important. This is preferred stocks. The first one I have is PFFA. It pays about 9%. It has an expense ratio of 2.52. Oh my gosh, a high expense ratio again. They use leverage. In that calculation for expense ratio, they have to show the cost of leverage. They're still getting your 9%. They're not charging you 2.52 to manage the fund. Their management fee is much less than a 1%, but they have to include the leverage cost, and they can get leverage cheaper than you can get leverage. The other one that I do hold is EIIA. This is a individual preferred stock. It pays 8.125 at par. And that's something I haven't really got into with everybody. So I was able to acquire this individual preferred stock below par. So what I'm actually earning on that money is slightly more than that 8.125. And when it becomes callable, they can call this away from me, but they have to pay me $25 to call it away from me. And I bought it less than $25. Right now, it's trading around that $25. Some days you can get it on a discount. Some days it's selling at a premium compared to that $25. But the way that I want to do preferred stocks and individual preferred stocks is to buy it below par. That guarantees me when they call it away, guess what? I'm still getting my $25. Now, EIIA is from Eagle Point Credit Company, institutional part, something that is not available to retail. This is a preferred stock that is in their institutional side. But this preferred stock is available for everybody to actually own. You don't have to be an institution to buy this institutional stock that goes to Eagle Point Credit Company, which is a CLO company. And I just want you to be aware of that. I will also point out that the CEO of Eagle Point Credit Company doesn't own a bunch of shares in preferred stocks in other funds that he manages, but he does own EIIA. And that is an interesting point of view when the CEO doesn't own one preferred stock that he's selling, but owns the other preferred stock that he is selling. Just pointing out what CEOs are holding and not holding. Not financial advice, legal advice, or any other advice. You should really seek a tax professional, personal opinion. Now, let's get into the alternatives. My alternatives are BTCI. It pays between 25 and 28%. It does have a higher expense ratio of 0.98. I also have LFGY. This has a lot of minors in it. It pays weekly. It has IBID in it. It's a very small percentage, and I'm using some of those funds to build out other funds as well as reinvesting in LFGY. It has an expense ratio of 0.99, but I like that it pays weekly. I like that it holds the underlyings and it's not synthetics, and it's a very small percentage of my portfolio. The next one is IYRI. This is a REIT ETF that sells cover calls, and it's paying between 11 and 12% with an expense ratio of 0.68. The last one is a bond fund, and this is a kind of a hybrid bond fund, HYBI from NEOS. It pays right around that 8% to 9%. Last time I looked at the website or checking up on things, it paid 8.81 with an expense ratio of 0.68. Now, it holds bond funds and it holds short-term treasuries. So it's really a hybrid between the two. It has both. The last section is CLOs. Not going to get into what a CLO is. You can go see them below, but let's go through the CLOs. I have EIC, Eagle Point Income Company. It's paying right around 15%. It has a higher expense ratio, 4.35. They also have some leverage, and you have to go figure out what expense ratio you want to pay. I am okay with higher expense ratios in these funds because there's more to them and there's more things that get calculated into expense ratios compared to just management fees of an ETF. That is, an EIC is a closed-end fund. Now, I also hold FSCO. It's paying about 11%. It has an expense ratio of 7.53. FSCO has been clearly one of the best performers I have in my portfolio, far and by none. I mean, want to talk about NAV appreciation? FSCO over the last year is clearly doing outstanding and paying me 11%. Just pointing it out. OXLC, 21%. It's a closed-end fund. It has a 5% discount on its drip. So I'm really getting about 26%. It does have an expense ratio of 12.45. Just pointing out that it's a little bit higher than everything else. But I'm going to give you a little tidbit. Remember I talked about the CEO of Eagle Point Credit Company and Eagle Point Income Company? Well, that CEO also holds OXLC, which he's not the CEO of. Interesting. And he is a CEO of CLOs. So you tell me. And by the way, OXLC is right down the street from ECC and EIC, like in the same like neighborhood. Just pointing out that these guys are all interrelated to each other and they're all professionally managed. That's something I enjoy watching because it is a small group. The next CLO that I have is JBBB. It's paying about 7.63%, and this is a ETF, and it has an expense ratio of 0.49. Lower expense ratio, but they do BBB, which is in the debt tranche, not the equity tranche. And I should be pointing out that OXLC is in the equity tranche, and EIC does the debt tranche, but has a majority in the equity tranche. So you got to pick out where you want to play in what tranche. Again, link to videos down below so you can figure out which fund is for you. I also own SPMC. It's paying right around 14%. It's a newer fund. It has a expense ratio of 9.18, but it's a newer fund, and this one, and I chose this one because one, it was a recommendation from some professional traders. Two, it's a newer fund, and as this newer fund has loans that are now paying, you're going to see the price have a little appreciation, and you might see that payouts go up slightly, which is going to cause the NAV to go up. So it's just a play on that section. Not a huge holding for me, but I will be building that out over time. Clause, CLOZ. It pays right around 9%. Has an expense ratio of 0.5. This is also an ETF. And I should say, just word of warning, it's an ETF, not a closed-end fund. There are several more factors that have to come into play with ETFs compared to CEFs. I'm okay with holding it. You have to do your own due diligence of what the difference between an ETF is and a CEF is and make a decision if you want to hold them. Clause has generally BBB and BB. That's what they have in their holdings. They have the two. The last one I have is JAAA. It has about 6%. Majority of theirs is AAA, couple double A's, and a single A. They hold no B's. Just to make sure the clarification of that, hold no B's, but they have all triple A's, some double A's, and some single A's. Now this is where I'm storing cash. I think that you should also have a cash fund. I have cash that I use for withdrawals. I have cash for future trades and if the market goes south. And that's where my money is in GAAA, just in case the market goes south. I can pull funds from JAAA and put them back into other funds. I still hold IVV, I still hold QQQM, and I still hold Berkshire Hathaway. Those are not income funds. Those are for my total growth. As I'm getting more into retirement, I'm going to start switching those out to other funds, but that is a future video. Hopefully you enjoyed this. This is what I hold. And if you're a member, they have access to all of this. They see a live spreadsheet every day, and they are out there watching what my actual funds are doing every day, because I can see how many people are looking at that Excel spreadsheet. And I go on and I see 15 people looking at my Excel spreadsheet to see exactly profit loss, what I have, what I'm selling. And I also do videos and tell them what I'm buying, what I'm selling, what prices I'm going to be selling at. If that's what you're interested in, become a member. But you don't have to, because I am going to do this on a monthly basis anyway. But if you want to know exact percentages, then you have to become a member. Until next time, God bless.